we are now going to talk to Matthias.
Thank you very much for the invitation, and I look forward to explain our investment philosophy. When I say our, it's Baring Emerging EMEA Opportunities, BMO PLC. As you can see, we are operating essentially in the time zone that encompasses emerging markets. In our time zone, in the emerging markets that are covered in our time zone, and that is an area that spans from the Cape to Gdansk in Poland, and from Kazakhstan to Morocco. But the main 5 markets would be the new EU member states: Greece, Turkey, the Middle East, and South Africa. So this would be the main markets. These are these economies altogether encompass approximately 400 million people. So it's a sizable consumer market too. However, it's from our perspective unjustifiably so often overlooked. So it's not really covered from the developed European side. But also within emerging markets, the focus is very much on, of course, Asia, and very often also LATAM. And we think that EMEA will play a much more important role in emerging market portfolios in the future. And the reason for that is that we see attractive growth opportunities, but also interesting valuations. On top of that, we think it's a diversified backdrop of uncorrelated markets. Take, for example, the fact that some of our economies are major energy or commodity exporters. Others are big commodity consumers. Then we have export champions such as Poland, for example, but also countries with a very attractive demographic structure such as Turkey, and also the idea of some countries becoming energy hubs, not energy exporters, but rather energy hubs such as Turkey or Greece. And of course, the green transition, as in many other geographies, plays an important role here too. And we do believe that EMEA will continue to play an important role to deliver energy to various places across the world, but probably in the future in the form of electrons and not in the form of barrels of oils or cubic meters of gas. So that's for growth and diversification and valuation. I think if you take all of that together, right, you can generate a portfolio that should overall, we believe, enhance the structural quality arguments within a broader portfolio. So in other words, we think EMEA does add quality to global portfolios on the equity side of things. And the qualities I highlight here are, apart from the growth that I have briefly discussed, also a defined income strategy here. So this is this portfolio of ours. This trust is not set up as an income trust. However, it is the sheer fact that valuations are quite attractive, and that translates the dividends into a relative attractive yield. So companies are actually boasting moderate dividend payout ratios. So investment levels are high, and that's, I think, testament to the growth opportunities. However, the attractive valuation of the region allows us to also return an attractive dividend policy, or run an attractive dividend policy, and that expresses itself in a yield that hovers around 3%. And we think going forward, and that's the important message on this front, we think going forward, the DPS of BMO can actually increase, and that should allow shareholders, we believe, to combine an attractive growth asset with a solid income element. We run a portfolio that is highly concentrated. So these are the five major hubs that I talked about translate into a portfolio of between 30 and 60, but normally between 30 and 40 to 45 stocks across all regions and across all sectors. So we tend to see our job in picking the right stocks. We don't run major sector or country bets. So this is very much based on stock picking. And we draw our ideas from a dedicated team at Barings of 4 individuals, and that includes also myself. We have an experience of more than 25 years in the region. You do see that performance has recently suffered, right? And that's something that I'm actually quite proud about. That sounds a bit funny, but you have to take into consideration that we wrote our Russian exposure to 0, and that's example. And you can see what kind of effect this had on a relative and absolute performance. We had about a quarter of the fund invested, a quarter of our portfolio invested in Russia, and that was written to 0. We have since, I believe, recovered nicely, and I'm very confident that we continue on this path. Right? It, I think, demonstrates the inherent resilience of the entire portfolio, that such a big blow was actually dealt with in what I think is a very positive manner. So going forward, as a shareholder, you are still owning Russian assets, and that presents an optionality in the long run, of course. However, it's important to stress here that we have written those assets down to 0. We demonstrate our relative performance since the events in Russia and the Russian war of aggression in Ukraine. In this chart, you do see that we have outperformed substantially since then. Clearly, we'd like to see an overall positive performance. So it's not, it's not nothing to write home about in the sense of creating wealth for our shareholders, but we want to point out that we have substantially outperformed the underlying benchmark, and that gives us confidence that our approach is the correct one. I highlighted the yield of approximately 3%. You do see that the underlying portfolio yield, dividend generation, revenue generation has suffered a bit. That's actually a very good sign. So we have diversified our portfolio away from Russia in 2018 and 2019. Russia was a very attractively valued market for a long time. We wanted to have more stability, more diversity in the portfolio, and therefore steered the overall portfolio away from Russia. Yes, we were still invested to the tune of about 25%, but that's substantially less than other competitors in the EMEA field. That also meant that the underlying dividend generation and revenue generation fell in 2020 and 2021, as Russia was just a very, very highly dividend-paying market, and diversifying away from it meant lower dividends. Now that Russian dividends have completely marked down to 0, you do see that we kind of dropped back to the level of 2014, 2015, but we are confident that we can grow from the current revenue generation again in the future. As I highlighted, this is not a primary objective of us, but we do believe that it is reflective of the underlying attractive valuation in the region, and the board of directors does consider the underlying revenue generation in a way that it will be returned to shareholders, everything that is generated. The portfolios that I highlighted, to you is invested in this 5 regions. You do see, if you look at this pie chart, you do see more markets than that, but as I pointed out, I would describe it as an emerging European part, which is approximately 20 to 25%, and here countries like Greece and Poland and the Czech Republic are featuring. Then we have about 30, we have about 1/3 in Saudi, plus other Middle Eastern countries and Turkey. That would be another 20%, and the remaining 1/5 of the portfolio is invested in South African stocks. So this is our current portfolio, and as I highlighted before, do not expect us to run major country or sector bets. If that's the case, we kind of would run out of underlying investment ideas on a single stock level. We don't think that this will be the case in the near future, as we see substantial opportunities on the single stock levels across sectors and countries. The largest sector, talking of which, right, the largest sector in our region is the financial sector. So we are quite confident about the opportunities that we find in banks, insurance companies, and stock exchanges across the entire region. I think this also marks or highlights an important difference of the region relative to developed markets, and especially the US. We think that the underlying problems that we see in the US banking space and regional banking space cannot be extrapolated to our region. We also highlight that financials perform very well against the broader index. So one of the reasons why financials actually stand at this relatively large share is the sheer fact that financials have performed extremely well over the last couple of years. And we do see that this will continue in the future going forward. But as I highlighted before, this is very much stock specific and stock idea driven, not so much just a bet on one particular sector. But importantly, going forward, we do believe that there's still more money to be made for our shareholders in the financial sector. Talking about stock picks, I've highlighted 3 companies where we are currently invested, where the portfolio is currently invested. These are 3 sectors, these are 3 geographies, and we also think 3 were quite attractive opportunities from in the medium term. Let's start with MTN from the left-hand side. MTN is the largest African telecom operator. We also attracted to the stock on the back of its very successful mobile money application. We think that MTN will be able to generate substantial growth rates going forward, and we also think that one of its largest markets, Nigeria, is actually moving into the right direction with regards to its currency regime. We've recently seen a major devaluation of the currency of the naira in Nigeria, and we think this kind of opens the way for a more constructive approach on monetary policy in Nigeria too, and this should ultimately translate into value on the MTN stock level in our perspective. The next stock is Tata Wool from Saudi Arabia. It is the stock exchange, the Saudi stock exchange. We think it embodies a lot of the ambitious aspects of Saudi Arabia and the Saudi government. We think its management is actually steering the company into exactly the right direction, and we think that the deeper Middle Eastern stock markets and the increasing financial inclusion opens up very, very attractive growth opportunities for Tata Wool down the line. So that's a stock pick in Saudi Arabia in our portfolio. And lastly, Alpha Bank of Greece is a stock that will benefit from economic healing, has benefited from economic healing in Greece. We think that the Greek economy is actually the most attractive one in all of Europe. So not only the emerging European part, but all of Europe. We take confidence in the re-election of Prime Minister Mitsotakis and his team, which will allow the Greek a success story, this remarkable success story, actually continue. We believe that Greece is also a market that will disproportionately benefit from a very strong tourism trade in Europe. And overall, we do also believe that foreign direct investment, something Greece has lacked for a very long time, is actually going to return to Greece, which ultimately will lead in an upgrade of the sovereign risk, maybe in September by S&P to investment grade. And I think this will then open the next chapter for Greek banks, and specifically Alpha Bank is a stock pick here, where we see attractive valuations at price book valuations of approximately 0.5, which we think is substantially undervalued. So these are three typical examples of stocks in our portfolio, and we find, as I highlighted, stock picks and interesting investment opportunities across all sectors and all geographies in EMEA.
Great, thank you. Should we pause there? That's sort of like a summary slide, and then we'll just go to some of these questions, I think. If I go first, just one that came up. With the spread of countries here, places like Tunisia, maybe, for example, are there other countries that could come into the portfolio other than the ones that are highlighted in green?
In the short, we do anticipate. So to answer you straightforwardly, no, right? I don't think that any country that is not covered in green, would make it into an investable place anytime soon. The big question mark here is Iran, right? For example, that's something, with the very fluid geopolitical situation, certainly could become interesting in the medium to long term. You will also notice that Ukraine is not covered in green. Ukraine, of course, would also become extremely interesting should the geopolitical situation change going forward. But my answer would be more specific in the sense that just because the countries are not covered in green and we don't deem them investable from the stock market perspective, doesn't mean that we can't invest in it. One of our largest holdings is OTP Bank of Hungary. And you do see that Hungary is a country covered in green. However, its business and its loan book is only to a minor part in Hungary. It's actually less than 1/3, and more than 2/3 are in countries that are not even covered on this map, at least not in green. So that would be the frontier Balkan markets of former Yugoslavia. So countries like Serbia, Slovenia, Croatia. These are not covered in green. But also, for example, the largest Central Asian market in terms of population, that would be Uzbekistan. So that would be my answer, right? Just because of the fact that we don't directly invest via the local stock exchanges in, let's say, Croatia. That doesn't mean that we can't find exposure to these geographies if we wanted to. And indeed, in the case of OTP, for example, this is very much the case. And we are of the opinion that OTP is an attractive investment.
Okay, thank you. Now, you said obviously Saudi's a big part of the benchmark. You're only sort of 1% underweighted, with 32% almost weighting. What's the investment case for Saudi Arabia at the moment? What makes it exciting, do you think?
This is a very straightforward answer, and it's actually the idea to transform the country and move it away from its overall dependence on hydrocarbons. And I think that's super exciting, even though I might come across a bit subdued, but I think it's super exciting. And if you look at it in detail, and you can look at it in detail for days and days, right? The kind of a sheer amount of the transformation policy and objectives are really quite tremendous. So it's also, I think, noteworthy that this is being done in an inclusive way. In other words, Saudi Arabia actually seeks to reach out and to involve investors on all levels, be it in private investments, be it in credit, be it via the stock market and IPOs and privatizations. And that goes across the sectors that you would think would be affected by it. Of course, utilities come to mind, right? When it's about creating an infrastructure and backbone for green transmission away from hydrocarbons, and using the vast abilities the country has in terms of solar power, for example, to harness that, to invest into green hydrogen generation and export facilities. When it comes to tourism, when it comes to healthcare, so all of that, from my perspective, is actually quite encouraging, and it's also very inclusive. Therefore, I think the old mantra that Saudi Arabia is entirely dependent on the oil price and ultimately it's an ultimately one-trick pony is not going to hold, and therefore we are quite happy that we find these investment opportunities across Saudi Arabia.
Okay, thank you. I mean, following on from that, I mean, obviously the oil price is weakening at the moment. Does that actually have an influence on the things that you hold? I think my understanding is you probably hold most things that aren't really hydrocarbon related. Is that true?
It's absolutely true, right? So when we statistically, so there are two answers, there are two elements as an answer, right? First of all, statistically speaking, we after we do see very little impact from an oil price falling or rising, by the way, right? So statistically the portfolio shouldn't be impacted by too much, but you can't measure everything with statistics because it's more from a more qualitative perspective. We try to have a balanced approach, not only in sector and country wise, but also from the perspective of not being dependent on factors. And if you take that into consideration, you're absolutely right. There are companies and geographies indeed that would benefit from a lower oil price, and there also and vice versa. And overall, I think it's fair to say that it balances out.
Okay, thank you. Can you talk us a little bit more detail in the investment process about how you put together the portfolio, given that you've got this sort of benchmark aware asset allocation?
Yes, so
how do you choose?
No, thank you for asking me that. I think for me it's something that fascinates me on a day-by-day basis, even though I've been doing that for such a long time. And I think that's the benefit of actually operating in a semi-efficient market at best. So I wouldn't like to compete against the S&P 500, right? But I do think that in emerging market, it still makes a lot of sense to run a bottom-up investment process that is focused on growth at a reasonable price. This is something that we have been doing for quite a long time, but it's really focused on the idea that I highlighted at the beginning of our conversation, where I said, like, we do see an environment where the revenue generated by the underlying portfolio allows us to reward shareholders in the trust by paying out those revenues, and that translates into a relatively high dividend yield. At the same time, however, the payout ratios itself are actually moderate, i.e. a large part of the underlying generated returns are being reinvested in the company or used for M&A. And I think that's exactly that embodies the very spirit that we are trying to achieve here, right? Growth at a reasonable price. We do look for attractively valued companies that can grow over time, and we do that by we do that in a way where we are absolutely benchmark aware, because we think the benchmark makes sense, right? We do think that the benchmark performance will translate into an attractive performance over time, and our aim is to add to that, to add percentage points to that, to the tune of about 1 to 1.5% per year, This is how we approach it. It's also important to highlight that the investment universe is approximately 200 stocks. We're a team of 5 people, and we also collaborate with other teams at Barings, mainly in the commodity space and the natural resources space, where some of the stocks are being covered by the resources team, for example, the South African miners. So from that perspective, we can really say that EMEA is a region where you can actually cover a large part of the investment, if not the entire investable universe, bottom up, with a team of experienced investors.
Okay, thank you. One of the questions that's on here is talking about the impact of tensions between China and the US and whether that makes a difference to what you're doing. I think that's from an angle of like we see in Asia. You see this China plus one thing where people are shifting manufacturing out of China to other countries. Is that true of any place here?
Absolutely, it's a good question. Something that kind of makes us we discuss a lot, have been discussing a lot over the last couple of years. I mean, and it has 2 effects on my portfolio. Firstly, of course, I do believe that it will increase the overall attention, I think, towards EMEA. Simply because I think investors will look for diversifying elements in portfolios, in global emerging market portfolios, but I think also in global equity portfolios. And the EMEA comes across, and the EMEA actually stands out, we believe, as relatively independent of the China-US relationship, and therefore should offer an interesting additional element to anyone's portfolio, and that is diversification, attractive valuation, and yield. On the one side. On the other side, and that's more company specific, yes, we do see that certain areas, especially outside of Africa, do already benefit from increased foreign direct investment. So I mentioned Greece. That's more of an idiosyncratic story. Greece is more kind of turning from a very uncompetitive place into a much more competitive and welcoming space for investors, and we do see that there's a kind of normalization going on in foreign direct investment in the Greek economy. But more broadly speaking, just today you saw the announcement that Intel plans a $4.3 billion investment in Poland for a new fab production site. So that's what we talk about, right? That's the nearshoring. Only a couple of years ago, I bet you that this investment would have taken place in Asia, if not China. But that seems to change now, and countries in EMEA and emerging European countries, for example, do I think qualify and actually lead the pack on a global scale as winners, right, out of this development. Likewise, the Middle East. Here it's probably not so much production, but also that is seeing investments, especially in Turkey, which benefits from the fact that it's in a custom union with the EU. But also, I think as an energy hub, right? So Russia is certainly gone for good, right, from the perspective of being a reliable partner. Especially from the European perspective, but we even see that China isn't too kind of forward going in signing its energy dependence over to Russia. But we do see that with regards to sustainable electricity generation and moreover the green revolution, we do see much more investments in what is simply the best place to produce energy from renewable sources, and that's the Middle East, be it offshore wind or solar parks in the best suited places in the world, right? So, like I highlighted before, Saudi is certainly a place where the policymakers are very willing to invest a lot of money to create the infrastructure to be able to enter what is going to be a very symbiotic relationship, I think.
Great, thank you. You mentioned the devaluation in Nigeria. I mean, and obviously the dollar swinging around, that has a big thing. Do you attempt to manage the currency risk within the portfolio, or is that just impractical?
No, absolutely not. We're not managing the current. Absolutely not. And it's completely impractical. What we want to do is diversify the underlying portfolio in a way that we're not hit, right? And you do see that the devaluation in Nigeria had absolutely no impact on our NAV. To the contrary, we increased the NAV over the last 2 weeks. We of course have an opinion on currencies because we have an opinion on valuations and we have an opinion on the economic outlook of countries. So we can, if you know from the practical perspective, I can tell you that it is completely obsolete trying to hedge that. You know, what you do is, of course, you express it in your stock views, right? And I think that's where our knowledge comes in. Take the Turkish lira, which is another interesting development recently, right? So we think that the Turkish lira has been substantially overvalued for quite some time, and that's no secret. And it has come off substantially, but our portfolio has our Turkish exposure in our portfolio has not suffered a lot because we prepared for that. We invested in one particular high quality export stock called Koç Holding, one of the largest auto manufacturers in Europe, and the largest light commercial vehicle producer in Europe, mainly for Ford and Ford Transits. Light commercial vehicle everybody knows, but if you come across a Ford Transit anywhere in the UK, rest assured that it's produced in Turkey by Koç Holding. So this would be an example of how we mitigate currency risk by letting our currency opinion be part of the overall stock picking process.
The political risk as well. I mean, obviously, with the recent election in Turkey, is that something else you try and manage, or do you just try to?
Well, look, we think it's inherent to emerging markets. So I mean, the best, I don't want to spend too much time talking about Russia, but that's of course something that's political risk that has hit us hard, right? But I also want to highlight our decision to diversify, right, away from emerging Europe, where Russia was up to 70% of the underlying index, away from emerging Europe into EMEA, and that's how we manage risks, by diversifying it, right? And that's why even though we have written down 29% of our portfolio to zero, we still have a positive performance over 5 years. So I think that and there's still the optionality that those assets might one day come back to shareholders, or dividends of those assets will one day come back to shareholders. We just have written it down to zero. So my answer is that we live in a world where political risk is becoming much more tangible, right? But at the same time, equity indices are at all-time highs across the developed world. So I think it's just part of our daily lives. For us as fund managers, we believe it also creates opportunities. Take Greece, for example, right? Such a basket case and laughing stock only a couple of years ago, right? And now one of our largest holdings in the portfolio, and the stock that I took it as an example, Alpha Bank, was returning 5x since October 2021, right? So in the space of 2020 rather, so in the space of under 3 years, the stock has returned 400%. So kind of political developments don't always have to be negative. I think it's important to run a diversified portfolio. So even a catastrophe of, I think, epic and historical proportions, the Russian war of aggression in Ukraine, was actually a development that hurt us a lot, but we were able to mitigate.
Okay, thank you. You talked a bit about the dividends. Just sort of a question here. From this level now, will we see a progressive dividend from here on? Is that what the board?
Yes, that's what I think. We're not promising anything for the sheer reason that we are not aiming. We're not aiming to generate yield, right? It's a side effect, I think, which demonstrates the attractive valuation. So we never buy a stock for yield, but it's important to note three things. Firstly, we already see in the year 2023 that the underlying revenue generation is actually being shored up, so and heading north. So we are somewhat positively surprised by the underlying revenue generation of the portfolio, and we think this is indicative of better things to come. That takes me to point two. We do see that, especially in the European financial space, we do see that a lot of the dividend, that the regulatory framework that did not permit dividend payments is actually being lifted, especially as I highlighted in the financial sector space. So we do think that the larger part of our portfolio going forward will actually be dividend paying. So that should also contribute to higher dividends going forward. And last not least, the third point, we are of the opinion that the currencies we invest in have room to strengthen from here against sterling. So we're just coming out of a, I think 3 to 4 year period of currency weakness, and that's exemplified by the situation in Nigeria, for example, but also South Africa, also Turkey, and even the euro and the European currencies have actually been somewhat weak against sterling over the last couple of months. So, we think that is coming to an end now, and going forward, we think that a large part of our portfolio could actually appreciate relative to sterling, and that should create a nice tailwind for underlying revenue generation. Therefore, also dividend, as the board of directors follows the policy of returning the entire net revenue generated to shareholders.
Great, thank you. Just on the Russian question, presumably those stocks are still paying dividends. Are they going into an account on the funds behalf somewhere? Or
now this haunts me in my dreams, the situation. So I mean, the optionality in the portfolio is huge. So yeah, I don't even, it's difficult to talk about it, but essentially, think about it, right? This is a this was a third of the portfolio, or like 30% of the portfolio roughly, which means, so of course, that means it represents over 45% now, right? Because it's 30 over 70, right? And so there's so you have this 40% sitting aside, and yes, Russia is in a wartime economy now, but we do see so dividends are not as high as they used to be, but they are still there, right? And they are significant. So if you add one and one together, quick back of the envelope calculation gives you about 4%, up to 4% of the NAV being generated in dividend per year in Russia, right? Yeah. So, and that accumulates. Yeah. But do I suggest that this has any worth? No, certainly not, right? But it's an optionality that one day could mean that BMO, which is currently valued at a deep discount, sadly, to its NAV, right, could actually stand at an extremely deep discount, right?
Yeah, it's slightly odd that
it could also mean that dividends return in a way that we have seen in the past, right? So
yeah, exactly. But I said it's slightly odd that you're on a discount and JP Morgan Russia's on a massive premium for the same thing.
Like I highlighted that haunts me. It haunts me in my dreams, but okay, I cannot give you an answer why this is the case. Yeah. I think it's unjustified.
Cool. Going back to this portfolio, what's the sort of turnover like?
Turnover has been dropping. It's a drop from 60% into the high 40s. And we are quite comfortable with that, right? So essentially we are turning 3 to 4% per month. And and we are very happy with our performance as of late. So, we have been very patient in our approach, and we have been rewarded for that, looking well, in the performance relative to benchmark. What I want to say is that following the investment process leads us into a situation where we are medium to long-term investors. We're not traders. Clearly, right, if price targets are actively and quickly reached, right, that of course triggers a process of reevaluation and potentially portfolio and the rejigging of the portfolio. But it just hasn't been the case as of last, right? We have seen a steady and very good development in a lot of the stocks that we own and that we like. Others, in other geographies, mainly Saudi, that wasn't as vibrant as of recently. But that hasn't prompted us to become more actively trading.
Okay, thank you. Lastly, I think gearing. Do you actually use gearing on the fund?
We can, but we're currently not doing it. So do I see an opportunity to gear? We looked into it. The short answer is no, not in the future, right? Not in the near future. What we want to do is generate relative outperformance by stock picking. So in other words, we think there's so much opportunity on the alpha side of things that we don't have to jig the beta. And events like Russia, right, also make you aware that beta can be very, very dangerous in events where you actually want to rely on the fact that your portfolio is very diversified. So we were not geared when Russia happened, and that allowed us to keep a very cool head and look for opportunities, much rather than frantically trying to de-gear the portfolio. I have to admit, however, that after the Credit Suisse debacle in March, we briefly looked into gearing because we wanted to acquire AT1 listed AT1 bonds, which we consider equity and therefore investable, of various banking names in emerging Europe and in Africa. But the process was just too slow, right? To set up gearing, that takes a few days, and that's okay, right? That's completely okay. And the underlying prices moved too fast in the AT1 space, and therefore, we didn't deem it attractive anymore.
No, fair enough. Actually, there's one question we should probably just answer before we finish up. Do you still hold NASPers?
We invest. Prosus would be our preferred vehicle here, right? Parent company. So the answer is yes.
Okay, cool. Thank you. Right. Well, thank you very much, Matthias. So we covered an awful lot of ground there.
Always good to talk to you, and thank you for giving me the opportunity to present on BMO. Cool.
Well, we'll get you back again in a year or so. Thank you very much, though.
Thank you. Cheers. Bye-bye.
So thank you to everybody for listening to this. We'll be back next week talking to Jonathan Hick, who's the manager of Triple Point Energy Transition, which has obviously had a tricky start at stay, but I think he's going to try and explain why he thinks it's now set fair. So we'll see what he said to stay. So that'll be next Friday. And in the meantime, have a good weekend, and I'll see you next week.